This is Optimal Finance Daily, Magic Beans by J.L. Collins of jlcollinsnh.com. And I'm your host and personal finance enthusiast, Diana Merriam. We're going to get right to today's post as we optimize your life. Magic Beans by J.L. Collins of jlcollinsnh.com. For supposedly rational creatures, we humans seem irrationally drawn to magic beans. Being a geezer, I've been around long enough to see quite a few flavors come and go. What they all have in common is that by the time you start reading about them everywhere, the end is near. Let's see. I remember growth stocks were all the rage a while back. Why, any management worth its salt should be able to plow profits back into the business and reach even greater heights. Value stocks that paid dividends? Clearly run by managements with no vision, so lacking in ability that they could think of nothing better to do with profits than to pay them out. You want growth. Find companies with forward thinking, what a wonderful phrase, leaders skilled in deploying capital. Growth stocks. You couldn't go to a party without some guy telling you about his latest killing. Left everything in the dust. Until they didn't. I remember actively managed funds. The investment world is littered with the remains of once superstar fund managers. I remember houses. Oops, strike a nerve? Yup, stocks and bonds went up and down, but houses? Houses could only go up. See, people will always need a place to live, right? Seemed to make sense at the time. Why banks, and how could they ever be wrong, would even loan you money on all your equity. You could cash out profits and still live in the place. What could possibly go awry? I'm sure glad I learned how to lose money in real estate back in the 80s and before it was fashionable. Saved me a bundle in avoiding the latest debacle. I remember gold. How could I not? Every time I turned on the TV, opened the paper, or listened to the radio, people were spending huge sums of advertising money to tell me that I too could get rich buying, preferably from them, gold. It is, after all, the one true store of value through human history. There was even one place that offered to sell it to you and then for a fee store it for you as well. You never even had to see the stuff. Think about that for a moment. I remember reading about tulip bulbs. And now it seems everywhere I turn, the new flavor of bean is dividend investing, or even more impressively, the Dividend Aristocrats. I actually made some money last year riding the div stock wave. With all this new popularity, I should be taking my chips off the table soon. No better sign than the end is near for them. So no magic beans in the Dividend Aristocrats, but they likely won't be as poisonous as some of the other beans. You'll just lag behind the market over the next decade. In fact, here's a bet that will likely make you more money. Within 5 years, you'll be reading about how growth stocks are the sure path to prosperity, and value dividend stocks are for losers who can't do the simple homework of analyzing the good stocks. This will be wrong too. What is poisonous in the Dividend Aristocrats post is this. Quote, "For a great primer on valuing stocks, check out The Intelligent Investor by Warren Buffett's mentor, Benjamin Graham. Read it and then get to work combing the aristocrats for bargains." End quote. It's a great book, and by all means take the time to read it. But remember, when Graham wrote it, index funds would not be invented for several more decades, and mutual funds were few and far between. Analyzing and choosing individual stocks was the only option. But now, thank you, Jack Bogle, we have index funds. With these, we can own the entire market and outperform over time all but the rarest of professional money managers. This idea that if you read a few books and study what Warren Buffett has done, you too will outperform the market is To steal a phrase from Sean's dad, horse hockey. Dangerous horse hockey at that. People have been trying for decades, and yet there's still only one Warren. Think about it this way. Remember Muhammad Ali? The Warren Buffett of boxing in his day. You and I could have followed his training regimen, maybe even engaged Angelo Dundee to show us the ropes. We could have gotten in top shape, done all our homework, learned the sweet science. And after all that effort, would you climb in the ring with Joe Frazier or George Foreman or Sonny Liston? Not me. I'm no Ali or Warren. Neither are you. Unless, of course, you are, which in case, welcome back. You know what Warren Buffett recommends for individual investors? Broad-based index funds. Graham, were he still alive, would too. A little humility goes a long way in saving your ass and your stash. Addendum. At various points in this blog, I suggest only about 20% of active managers outperform the index. That's being a bit generous. This is a ballpark figure based on the many articles I've come across on this over the years. In fact, you can Google this question and find several falling around this percentage. I'm not sure why they vary. Some look at different time frames, some at different metrics, some factor in costs, some don't. Clearly, it's easy to get lucky and outperform the shorter the time you need to do it. You just listened to the post titled Magic Beans by J.L. Collins of jlcollinsnh.com, and I'll be right back with my commentary. Buy low, sell high. Buy low, sell high. It's a simple concept, but not necessarily an easy concept. Right now, high interest rates have crushed the real estate market. Prices are falling and properties are available at a discount, which means F.I.R.E believes now is the time to expand the F.I.R.E flagship fund's billion-dollar real estate portfolio. You can add the F.I.R.E flagship fund to your portfolio in minutes by visiting fundrise.com/OFD. That's FUNDRISE.com/OFD. Carefully consider the investment objectives, risks, charges, and expenses of the F.I.R.E flagship fund before investing. This and other information can be found in the fund's prospectus at fundrise.com/OFD. This is a paid advertisement. I think the reason why it can be so easy to get caught up in investing trends is because we think the goal of investing is to beat the market. That's why I want to repeat a sentence from this post where JL says, quote, "We can own the entire market and outperform over time all but the rarest of professional money managers," end quote. The reality is that almost no one beats the market with any consistency over the long run. So by not trying to beat the market, you end up performing better than everyone else who is playing an unwinnable game. But the best part is this: you don't even need to beat the market to reach your financial goals. You will get there more easily and more reliably with way less effort if you simply match the market by buying low-fee total market index funds. Don't choose which stocks to buy, just buy all of them. Don't stress about buying low and selling high, also known as timing the market. Just consistently buy and hold until you reach your financial goals and start drawing down on that portfolio. Investing trends make investing look way more complicated than it needs to be. But as JL demonstrates in his widely read book, there really is a simple path to wealth. But that should do it for another edition of Optimal Finance Daily. I'll be back tomorrow as usual, so I'll see you there for the Wednesday show, where your optimal life awaits.